Good afternoon, everyone. I'm Jim Henry, Senior Editor of Auto Finance News. I'm pleased to welcome you to this webinar, Going Paperless, Tips and Tools for Every Stage of the Digital Lending Process, presented by the Center for Auto Finance Excellence. The Center is an industry resource that shares best practices and actionable advice with auto finance professionals. Auto Finance News and Fiserv launched the Center in 2013 for the benefit of the auto finance community. The Center shares its content through events like this and at autofinanceexcellence.org, which we encourage you to join. Our goal is to share unique content and insights on the practice of auto finance, furthering the overall management performance of the industry. Articles are added to the site all the time. Another recent topic was managing the ongoing wave of off-lease vehicles, for instance. Today's webinar is the fourth of our four-part series of webinars for 2015, presented by the Center for Auto Finance Excellence through the generous support of Fiserv. This pre-recorded webinar is scheduled to last about an hour. In the webinar, we will explore advantages and disadvantages of a digital-only system for direct versus indirect channels and offer valuable lessons and takeaways. Our speaker today is John Koehler, Vice President of Product and Partner Development, Car Finance Capital. John began working with Car Finance Capital in 2013. He began his career designing and implementing risk management technology solutions in 1999 with American Management Systems and moved into the automotive industry with DealerTrack from 2003 to 2009, where he led the new product development for online rehash, lease e-contracting, and credit card pre-screening, among other projects. From 2009 to 2011, John worked with Harris Interactive and also consulted to a few auto and finance-related startups based on the West Coast. In 2012, he took an opportunity with TrueCar to begin product development of TrueLoan, and soon led the dealer products and lead marketplace products as well. We will follow John's presentation with a Q&A. With that, let's get started.
Yes, hi Jim. Thank you for the introduction. Want to talk to you all today about how Car Finance Capital, and specifically our direct lending unit, carfinance.com, has evolved as a direct lender in the automotive space, but also gone through how to really be a digital lender, how to remove paper from the process and move auto lending into a more electronic and easier, more convenient process for everybody involved, specifically the borrower, especially the dealer as well on any purchase loan, and finally to be more efficient as a lender. To tell you a little bit about carfinance.com and Flagship Credit Corporation, our parent company. Flagship Credit Corporation was formed at the beginning of this year, in January 2015, through the merger of Car Finance Capital and Flagship Credit Acceptance, two companies that were both majority owned by the same investment firm, Perella Weinberg Partners. Car Finance Capital started its business in 2011, and carfinance.com was started at that time as the direct-to-consumer business. Together, as a joint operation, Flagship Credit Corporation, we now have a portfolio that exceeds $2 billion. Both companies, both Flagship Credit Acceptance and Car Finance Capital, achieved a little over $1 billion on their own, and since our merger, we've continued to grow that as well. In our business today with carfinance.com, we offer two types of loan products. On the direct side, we offer a refinance loan as well as a dealer purchase loan. And last major point about carfinance.com is that we are currently a nationwide lender. We're available in 45 states. There's a few other states we plan to expand into before the end of 2015. That would give us a footprint in about 47 to 48 states, and we are active in the District of Columbia as well. What we've seen in our 4-year history in direct lending with carfinance.com is there are a few keys to being successful in going paperless within auto lending. The first one is recognizing what are the documents that you need signed and acknowledged, and what is the best way. What is the legal requirement as well as what is effective in order to achieve removing paper from the process. And what we've seen is that, generally speaking, there are certain things that require a signature, although often an image of that signature, be it a scan from a fax, from an email, from a photograph of the signed item. Many of those are now considered valid. Secondly, there are a number of opportunities where it's not even a signature at all, as much as a very robust and clean process that completes with a user actively accepting something that indicates their consent and has the same power as a signature had in the world of paper documents. The second thing to recognize around paperless is it's not just the documents that are generated by the lender, it is also the documents that you need from the borrower. We have created a system specifically in order to collect those documents and get them into an electronic form. And obviously it makes it a lot easier for consumers who already have the information required, such as pay stubs or such as utility bills for a proof of residence, whatever it may be, to already have that in electronic form to then pass that along electronically, as opposed to requiring printouts that then need to be digitized through an image or a scan. The more that you do as a lender, the easier it becomes, because for a lot of consumers, it's a lot easier to simply put something into the mail or even just make a photocopy, which ends up with more paper, than to use some of these tools. So it's the easier you make it to update and receive electronic documents, the better. Things that requires a printout before being provided is usually something that is not as successful from our experience. So let me tell you a little bit about the carfinance.com process today. The 4 main areas where there is some bit of what in the past has been a paper document and how we've made that into an electronic document. We start the process, as any lender would, with a credit application. And we do need the customer consent in order to pull their credit bureau and to do employment verifications and to do all of the other checks that any lender will do as part of their credit evaluation process. We handle that today online with a customer consent, and that comes down to simply having a checkbox. Others use a button, but either way, requiring an action on behalf of the customer before hitting a submit button that actually results in transfer of data, that acknowledges the fact that they are agreeing with all of the terms and conditions, and also that they are agreeing to do business with us electronically. We call it the consent to electronic records. So we have both of those and require active consent, but there is no signature required for either of those today. The second part is getting the information back to the customer, starting the process with the credit decision, and we handle that through email. We do, in the case of a decline, mail out the adverse action letter, but there are a number of reasons for that, some of which actually are tied to the fact that we are a part in being part of the Flagship Credit Corporation, that we are a part of a larger lender that has a large indirect operation, and that those adverse action letters through indirect lending basically need to be sent by paper today, because we do not on the indirect side get the same consent to electronic records. As we try to bring that to the forefront on indirect lending, we may be able to change that decision. Nonetheless, all approvals for the carfinance.com direct program are sent by email, and only by email. We have seen that trying to spend the time on mail is both costly and does not lead to a great response because it's so delayed. Customers applied in minutes, they also want a response in minutes, and that's something we're able to grant through our virtual process. Once the customer has their approval email, it provides a link to what we've called the Doc Center, and that's where the post-approval documents go. So all of those stipulations we may need in order to back up and do the verifications needed around our approvals, such as a proof of income, a proof of residence, for refinance, especially the insurance card and the and the current vehicle registration. We have a tool that allows them to provide all of that information to us by uploading documents. So we also allow for them to email documents if they need to. So we have a way to get documents from them electronically, and it's as simple as attaching a file to an email, or in our system the same idea. If you press a button, it asks for the file, it uploads, and our people are seeing it within moments. Finally, once we have cleared all the stipulations and handled all the other documentation, our contracting today, we have a solution that includes using DocuSign. And so every customer that signs a direct loan, our note and security agreement, NSA, with carfinance.com is doing so electronically using DocuSign. It's as simple as they go to their email, they click on the link, they answer ID verification questions, and then they are presented their note and security agreement, and they sign it. And again, within moments, we have it, and we're able to complete the processing on that loan to make the necessary funds disbursement, whether it be to a dealer on a purchase loan or to a current lien holder that we're paying off in the case of a refinance. It allows us to turn around our funds that much sooner after the contract is signed, and generally have those contracts move from signed contract to funded in less than 24 hours. In refinance, it's usually the same day it's signed by the customer, depending on the time of day. Just to show you a little bit about what it looks like for our customers, as I said, we have them go to the loan center, which is, in particular, the doc center is the document stipulation side of this. They log in, they create their account, they log in, they see the full list of items they need, the status of those items, whether it's been already submitted and is pending our review, if there's any need to resubmit, such as if the image was not acceptable or the document was outdated or whatever it may be. And they can quickly click on the link in order to take the action. We also found that we have a number of stipulations that are informational, but that they are better off not as paper. An example being, we have a requirement similar to a lot of lenders of our type, and that are more focused on non-prime, where we want to know at least 2 years worth of employment history of the borrower. On the application, we may get less than that if their current job and their previous job time adds up to less than 2 years. We simply ask for additional information, and that can lead to more documentation steps, such as a pay stub from another job, or in the case of the time of job and previous job is too short, that we just do another employment check to make sure that the second prior job is still valid. But those kind of things are collected just by having a form online, so that the customer doesn't need to write out information or type it out and then print it out and then fax it into us. We have a place for all of those types of stipulations right now. It makes it a lot easier on us to get the information, get it correctly, not worry about bad handwriting, and most importantly, make it very easy for the customer. The thing I wanted to talk about was specific to the refinancing process. And in talking to a lot of different lenders who had an interest in direct lending but were concerned about dealing with the state when it comes to the state DMV, when it comes to the title work, that is one of the limitations we have today. We don't have a truly paperless refinancing process outside of the state of Florida. Florida's Department of Motor Vehicles today does allow a electronically signed document. So in that case, we are using our DocuSign solution to get the signatures for the power of attorney document. In the other 40-plus states where we are doing business, we are required to get both a wet ink signature, and in many of those cases, the customer also needs to get the document notarized. What we have found there is that we do as much as we possibly can electronically, and it both limits our cost, makes it as simple as possible for the borrower, and also cuts down on the time required to turn this around. In our particular case, we pre-fill the POA, power of attorney document, with as much information as we need for it to be accepted by the state. We provide a cover sheet that is specific to the customer and their state and their loan, as far as exactly what we need, whether we need a notary, whether the customer needs the document notarized or not. And in the case where they do need a notary, we even provide them a web link because the document they're receiving is still electronic, so that they can go and find a notary in their area. And also a site where they can use our prepaid postage in order to get the documents back to us after they have signed it and gotten it notarized as quickly as possible. So we have, we are limited to the fact that at that point they're going to need to have access to a printer. But once they have those documents printed out, they get them signed, they get them notarized as they need to. We have made it as easy as possible for them to then get it back to us so that we can continue the refinancing process as simply as possible. The direct vehicle purchase loan, which is our other type of direct loan that we're offering right now, we have actually found this to be very easy to go paperless, and we've actually seen it to be one of the big advantages of our process compared to indirect lending in the dealership. The first thing we do is, upon the verification of all the stipulations on the loan, we present to the customer an electronic funding certificate. They can print this out, and it also has all the information needed that if they wanted to just store it to their phone or tablet, that's fine too. But either way, it's a one-page funding certificate, has all the details needed for both the borrower and the dealer. And once the key things for the borrower is that they know the conditions of the vehicles that we fund, which is to say the age limitations, any model make and model limitations we have, and also the dealers, which is to say we preference franchise dealers. We will do work with independent dealers, but of course they require a bit more vetting. And the key thing is that all that information is on the one page for both the borrower and the dealer to see. The dealer then logs into a simple 3-page platform that we've put together. And from there, the dealer just gives us the VIN. They identify themselves by the make they sell on the new side and their zip code. And they give us that customer number that's on the funding certificate. It allows us to pull back all the information we need for them to complete the deal form. The deal form is as simple as just give us the amount financed and a service contract amount, so we have both an LTV and advanced calculations that we can run. We do all the verifications right there instantly through our verification engine. We generate the contract electronically, again, using a solution that involves DocuSign. And the customer both gets a text and an email with the contract once all the verifications have been done. And at that time, the customer will be able to sign their contract right there in the F&I office or wherever the dealer has them closing the car purchase deal. And the dealer is also instantly provided feedback when the contract first it was verified, and secondly when it was signed by the customer, so that the dealer knows they have a fundable contract, a done deal. They're going to get paid as long as they give us the title application and bill of sale and a few other documents, and they're able to close that deal without requiring the customer to take a lot of paperwork to their local bank branch or credit union branch or wherever it might be, or in doing any other kind of process where they're getting, paid on an estimated amount that's going to require some paperwork and feedback from the financial institution's office prior to funding the dealer. We have done all of that online, and the dealer doesn't even have to send anything in through the mail either. Everything they need to send can be done electronically. So even unlike an indirect deal where they want to overnight the contract and supporting documents in order to get paid quickly, with us, they're going to get paid within 24 hours, and all the documents they need to give us, they give us electronically, saving on cost for them as well. We just take a quick look at the homepage of our dealer site. You can see on there that, we ask for that customer number. We ask for the dealer type and zip code. Dealer type meaning, is it Toyota, Chevrolet, BMW, whatever it might be, and then the VIN number, because we're going to do a series of lookups, of course, to do all those items in order to make those validations happen as fast as possible. So we are able to pull back the deal, limit how much they need to enter here, because we know that they're really working out of other systems in order to close any car sale, mainly their DMS. So we want to make it as simple as possible. We've limited the total data entry to less than 10 fields for the dealer in order to close our direct purchase loan. So as we look at our overall process of carfinance.com, we basically have had three stages in our corporate life going back to 2011 when we started business. In the early, first year plus that we were in business, from the fall of 2011 through the second quarter of 2013, so about a year and a half period, all the approved applicants were emailed their approval terms and a stipulation list. We did not yet have the Doc Center, or Doc Center, which is a predecessor to the Loan Center, in place. So customers either mailed in or faxed in the documents that they were, supporting documents to clear stipulations. We were already working with DocuSign. We have been working with DocuSign since the beginning of our business, and therefore we had the DocuSign for the contract. The contract itself was an estimate. So it was estimated NSA based on the approval information. It may have been updated based on any additional information that came through the process, but it was not yet final because we waited until the customer's signature in order to have the final information. On the refinance side, things could change because, for example, the customer presented the contract, they don't sign it immediately, therefore a few days go by and that kind of eats into the 10-day payoff, therefore the actual payoff amount may have changed. In that case, and in every case, whether or not it would change at all, we had what we call FTIL, the Final Truth in Lending document, and that was mailed to the borrower. So that was the initial process. About 2.5 years ago, we improved the process substantially in the interim process. We still had the approval emails, but at this point, the Doc Center was brought online, the original Doc Center, and that had a link to all the stipulations for the borrower to upload again. So that, for example, they had an actual list in that Doc Center. It would say proof of income. It would say proof of residence. It would say, proof of secondary income or other monthly income. Any of those were then available for a customer to upload documents against. We also did allow them to continue to fax or email documents at that time. The loan contract also was going through DocuSign, but the new enhancement in the contracting process is that while we still had the FTIL, because we still had estimated loan documents, the FTIL was now published to the Doc Center. We did not email it either in the initial process or in the interim process because it was considered a document that you wouldn't want to put through an insecure medium such as email. So the introduction of the Doc Center as a secure medium requiring both an ID and a password that was based on what the customer registered with, we felt much more comfortable in presenting that FTIL document there so that it improved the process greatly, cutting down the time from just one more piece of paper that a customer gets in the mail that may or may not get read in a timely manner and that comes with cost, to something that can be delivered a lot sooner and a lot cheaper because it is an electronic document that we're able to publish, and then the customer in turn can also store that document as they see fit. If they want to make a printout to store with paper records, they can do so. If they instead want to store it with electronic records around their auto loan, it was much easier for them to do that because after all, the DocuSign, the NSA that they signed through DocuSign was done electronically, so it was a lot easier to put together two electronic documents so it was a much improved customer experience. Finally, we get to where we are for the last 10 plus months now. We implemented this process last year in the fourth quarter, but it was middle part of December when we actually rolled this out to the first set of states. And it's the current process that we have is we still are doing an approval email. It still links to the Doc Center, but the Doc Center has been rebuilt and greatly improved upon in terms of ease of use and styling. The borrower can, again, they can still upload any stipulation clearing document, such as a pay stub to clear proof of income or a utility bill to clear proof of residence. We still do allow fax or email, but while the percentage of fax and email during the interim process that ran for about a year and a half was upwards of 40%, we now have faxes down below 25%, and we're hoping to bring that down below 20% before the end of the year. The reason why is that we've just made the new Doc Center that much easier to use and that much easier and fits within how customers are using the web today and having more electronic documents. So the other big key is that there were a couple of stipulations we had that used to be documents the customer needed to print out and then sign, and then they could upload the signed document back to the doc center. That was what was leading to a good amount of the faxes. We have reduced that by changing those documents to being paper documents. They were related to getting the verification of employment authorization. They were also related to getting the payoff authorization that we would include with the payoff on closing a refinance loan. We have now turned those into forms that then in turn turn into documents that are signed through DocuSign. And that has greatly improved the process as well, and really also moved us to truly being paperless on the purchase side, where we did have that employment verification, and fully paperless in Florida, where we can have a DocuSign POA in addition to the other documents, and at least closer to paperless for the rest of the refinance process. The other big key in the contracting process is that we are still partnered with DocuSign. I'm very pleased with that relationship we've had for over 4 years, but that we have also now moved it to being able to generate actual NSA, note security agreement, for both the refinance process and for the purchase process, and therefore we no longer have an FPIL document at all. So there is nothing to either mail or email or publish to our doc center, because the customer's contract, they now have a copy of it, and that is their actual loan contract. So that has been the improvements we've made over the last 4 years since starting this business. If we look at some of the things we've learned in those 4 years, we have been very pleased with the growth of the business and with the customer reaction to our business. Customers broadly want to do business with innovative companies like carfinance.com that are really moving things and using new processes and making use of technology. All of that said, as I mentioned, we still have around a quarter of the documents we receive, the clear stipulations, come through faxes, and that's because there are certain customers that are just more used to the older technology. We don't really deal with the mail at all anymore, so that one has kind of gone away. But the fax machine is still there. There are some who it's just easier for them to use email because of their email is right there. Their email is right on their phone. They may have the documents they need. Whatever it may be, we have seen that some, despite presenting this doc center and the loan center, we have some who are more used to older processes. They may even feel that they're safer, even though that actually is logically not true. We have made sure that we're a flexible enough business that we can allow for a paper-based process where we need to. In terms of another key, and that's been to our success in growing our business in direct lending and competing with what is indirect lending, at least in terms of purchase loans, the electronic contracting options that were made available by major technology providers in the business have generally relied on signature pads. Those signature pads cost money because, after all, they're mini computers themselves. Many dealers only have a few of them and may not have them in every F&I office or cube or other places where a customer is going to close their loan. So really kind of skipping past and avoiding the signature pad at all in favor of something that can be done on the customer's phone has been a huge improvement, especially, obviously for our purchase process, but something that we actually see down the line as a possibility for the indirect process as well. We're not really sure. We don't have a specific plan for implementing that with the flagship side of our business, the indirect side of the business, but we do see it as something that customers have been very receptive to signing the contract on their phone, and we don't see a good reason why, even in the world of indirect finance, it will not become something that there should be no reason why a dealer shouldn't be able to present they'll have the information they need, such as a customer's either phone number on their mobile phone to text it to them, or obviously their email in order to send them the email of the link they need in order to execute that contract. But either way, what we did know is that we wanted to avoid going down any path that required hardware on the dealer, integration on the dealer, such as the signature pad that were in place. And finally, if we look at the refinance process, which has been the biggest part of our direct business, and is still the biggest part of most direct auto lenders' business, The biggest key is that a lot of customers don't really know that they can refinance their auto loan. Obviously, mortgage refinance is something that is well known. It may not be as popular as it was some years back, but nonetheless, it's a well-known concept to most folks, especially obviously homeowners. But the key to differentiating it is most people associate a home loan refinance with the fact that there are fees involved, such as the bank lawyer fee or other fees, and that it's actually going to take some time before they actually see savings to the refinance. The key is, and big part of auto loan refinancing is that there are no fees. At least for the carfinance.com, there are zero fees. As mentioned before, we will even prepay the envelope for them to sign, to send back the one paper document we need. And the key is also that if you were to present a big paper stack at the beginning and mail something out, even at your own expense, obviously, to get it to the customer, it kind of gets them scared of the process, versus if you present a rather simple interface for uploading necessary documents, of which we usually have less than 5 anyway. It has become very easy for the customer to see that this is a process that is simple, that they can close quickly, and that it can actually start saving them money from the first payment they make, which is something we strive for and something we require of any approval we make. And that, while home loan refinance you might be saving hundreds a month, you're unlikely to save over $100 a month in auto refinance. We see the savings generally somewhere between $30 and $60 a month, but obviously on a much smaller payment to begin with. So that percentage-wise, it's still a great level of savings, and it came with no cost and a rather easy process, which has been the key to being successful in growing our refinance loans. So that's really what I wanted to cover with everybody today as far as the process we've gone through for carfinance.com, how we've evolved over time, and how we've really used the ability to be a paperless lender right down to the last step of the process, the contract, to succeed and to really offer something different than the auto loan options that are available through to borrowers, especially through the indirect channel today at the dealership or compared to other refinance opportunities. I am very willing and open to answering any questions you may have about the process and about what how we've changed and evolved our business over time.
Sure. Thanks, John. I know one of the things that occurred to me in your earlier presentation, too, in Las Vegas recently was, can you talk some more about channel conflict, that is conflict with dealers? I mean, do they try to flip the customers? How do you go about keeping on the good side with the dealers?
Yes, that's a great question. And, one of the biggest things, Jim, about that is we try not to compete with a dealer in the standpoint of the customer that came to us looking for direct lending. We want to give them a great direct lending experience. And at the same time, we do that through a couple of different ways. One, we want to present to them a competitive rate based on their risk profile, and and the fact that we are, after all, an auto finance company. We're focused more on the non-prime space, so our rates are, they're not going to be the lowest rates you're going to see. They will probably not be the rates that a captive is going to offer in the times when there is specials going on. And so there's a couple of things to that. One, if we look at our purchase loan volume. And this has been the same both over the last year as well as in our life-to-date business. We have around 86.5% of the loans that we book are on used vehicles, and so they only 13.5% on new vehicles. And why that's important is that we're not trying to offer a solution for the customer that competes with the captive financing or with any finance goals that a dealer may have that requires them to place it with the captive for meeting bonuses for incentives and things like that by through loan count. It's really focused on the customer that's most likely in the market for a used car to begin with. So that's one way that we get try to avoid the channel conflict that goes away with being a direct lender in the indirect space. The other, of course, is where we implemented the new process that allows for the loan to be closed right at the dealership and minimize the work on the dealer. Because that's the other big part is we have done a lot of the work on this non-prime customer to close them, which is to say we already looked at the proof of income. We saw that pay stub, verified the numbers and that it's active, verified their current employment, verified their residence, did any of the other stipulations that would be common to our purchase loan, that if a dealer is going to move to a non-prime lender that is a competitor of ours in the indirect side, that's totally understood and more than likely where the customer's credit is. And yes, we understand that dealers will get paid either through the most common of getting a markup. There may be a flat or it might be percentage of amount financed, whatever it is as far as that amount, that compensation amount. The dealer's going to have to work for it, and I don't mean that in a bad way. I'm just saying that we've already done that work, and we want to make it easy for both the dealer and the customer, and that's why we did that work in advance. The dealer is able to sell a car and able to also sell a warranty product, and we have a very strong advance policy on that, up to 20% or $2,500, whichever is less. So usually it's still $2,500 that's available. So with that in mind, we try to cut down the conflict by having a program that lets the dealer make their money, but just not on the financing for a customer that's already gone through the work doing it with us.
Okay. And how often do your applicants, or would it be those who have applied or those who have been approved, get flipped? Is it a lot or pretty rare, or can you say?
Well, we don't have hard statistics because it's all we know is that, and the best way to look at it is those customers that we have gotten into issuing the funding certificate, and then how many of those end up in a closed loan. The third statistic we have some little bit of visibility is how many of those actually went shopping to a dealership, so that the dealer was at least probably reviewed our program and still decided to put the customer into a car with a different loan. We still think that it's probably up to about 40% that we're closing only around a little over half of the opportunities that we have reached the point with the customer that we have sent them shopping and given them the funding certificate. So it is still a lot higher than we'd prefer. We definitely want to bring that number down, but we also think that number is improved. We think that we were actually closing less than half the available opportunities last year, and that we probably have gone from about a 40-60 split where we were only getting about 40% to around 60-40 now, and we have seen that trending better, from the data that we can have around knowing those who actually went shopping and were cleared for shopping with our financing.
Yeah, that's very high compared to indirect, compared to the whole universe of indirect versus direct. That's pretty high for direct.
It is. No, undoubtedly it is very high, and you're exactly right, is that generally speaking, it is high, and it's not depending on how you look at things. The capture rate, meaning of the total approvals in the indirect side for a non-prime company like we are, meaning we have a similar credit profile that we're looking for on both the carfinance.com side as well as on the flagship acceptance side on the indirect side, our capture rate for a non-prime is not necessarily up to even 40% either. So you may have gotten that many approvals and still are closing maybe about a third of your approvals or so. Generally speaking, if you're, again, approving somewhere between a quarter and 35% of your loans, and then your book to look is still in the 10% zone, that's still only about a 40% capture or less. So if we compare it to that, it's not so bad, because after all, we already sent the customer in shopping. But obviously, the key difference to efficiencies on the indirect side is you wouldn't have to go through all the stipulation clearing work if the dealer didn't select you. So, we recognize that we do need to be up over half to be an efficient and effective business and provide the best available rates and the best available program to dealers. And that's why we're continuing to obviously drive it further. But we are pleased with hitting the 60% mark from the best we know in our data. Yeah,
I should think so. And you mentioned in your presentation that refis account for most of your volume. Did you not? Can you put any numbers on that, or what is that mix?
I can, and it is. If we look especially, so we look at refi versus purchase loans, The refi loans account for about 72% of our business, and that has not changed too much over time. So it's about 72 versus 28. I guess it's, if we wanted to put it into a simple fraction, that's roughly 5 out of every 7 loans we're doing is a refinance loan today.
Okay. And what's the typical circumstance for that? Is that somebody who got a higher rate loan previously and now their credit is better, for instance?
Yes. So there's several reasons that folks come to us to refinance, but the most common, I mean, obviously any refinance we're closing is exactly that we're able to offer a better rate, and occasionally we extend the term by a little bit, so therefore they also just seeing the benefit, lower monthly payments month to month. The impact month to month is magnified by the fact we probably brought the rate down a little bit plus extended their term, so together those two things bring a good monthly savings. But the key to offering the rate savings is a couple of things really. I think one is yes, the customer's credit has improved at least in some degree. The most important factor we see to consider and to approve on refinance is that they've been paying their auto loan as agreed. There may still have been blemishes in the time, of late payments elsewhere or, items like that since they had taken on that car loan. But as long as their car loan has been paid as agreed, they're likely to qualify with us, and therefore we're also likely to be offering a better rate than where they were when they got that auto loan. So, so that's the big key to it, is that if it's not their overall situation, it's at least that their auto trade line has performed. And in turn, we have seen that our refinance business has performed very well, which allows us to offer those rates because, again, we're obviously doing it's a risk-based scorecard that leads to our pricing. And, and seeing that our refinance customers, since they've already been paying their auto loan, they do continue paying their auto loan that they have with refinance with us. And that kind of history and performance leads us to then be able to present in the marketplace on new approvals rates that are probably better than they would be if the customer was getting a new car loan or whether that was through us or through one of our competitors that would have been made available to a dealership.
Okay. And can you provide some context for the stages that you went through going from somewhat more paper-intensive to less paper-intensive? What are the big drivers of that? Was it over such a long period of time that the technology actually improved, or was it a case of it became easier to do certain things when your volume would justify the per transaction costs, or some of each, or was it the plan all along that you would try certain things and make sure they worked before you added more? Can you take kind of a higher level view of that evolution that you described earlier?
Yes, absolutely. So it was really a combination of several of the items you just mentioned, Jim. We had, one is that, the technology improved and our technology development group has grown and improved so that we were able to expand the digital product offering that we had to be more feature rich and to make that borrower experience and dealer experience better. So it was really a key that, our technology prowess improved over time as we grew as a company, therefore allowing us to offer a better doc center for the stipulation clearing process post-approval and a significantly better process for the dealer purchase loan process. That was really the biggest thing that we offered, that came with the latest phase that was not available before, mostly because it just simply was not built. It was not something that we really saw a way to connect in with all the systems. We had also went and bought licensed a CRM through Salesforce.com, one of the leaders in that space, and it was a lot easier to integrate with their available tools to build out that experience than it was to connect a number of the other systems that we had in-house. So that was, that's some of the technology on our side internally. You also mentioned the external technology availability, meaning what do consumers have? And that was also a big thing, which is to say that as more and more of our customers had easy access to the internet, including on their mobile devices, it became a lot more feasible for us to offer something that included an active dealership tool, because we could count on the fact that more and more of our customers would have a phone, and not just any cell phone, but particularly a smartphone that would be internet enabled, allow them to get to their email, but also allow them to get to a mobile web version that would allow them to execute the contract electronically. So it was a combination of, as we saw the trends of consumer tech improving and moving in this direction, it became a lot more feasible for us to offer something in that regard that would allow our technology to be accepted and available to more and more of our customer base.
Yeah, and you have spoken too in the past about how customer expectations have risen for that sort of online experience, and that's raised expectations for the auto space too, right? I mean, is that something you've done some research on, or strictly anecdotal, or how do you see that?
Yes, I mean, the answer is that yes, the customer expectations has raised dramatically. If I think back to a number I think I shared in a previous presentation, and also was shared to me through a previous presentation I had seen at another conference early this year, there's, from a survey done last year, and I believe the source was done by MTV of all sources, but it was just getting into looking at millennials in particular. 72% of millennials would prefer to do their banking business, so anything related to payments, to credit, to savings, obviously, with a technology company like a Google, Apple, Amazon, even some of the big social media companies like Facebook were included in what was considered a technology company. Carfinance.com, we're not nearly of those the size of any of those four tech behemoths I just mentioned, obviously. Flagship Credit Corporation, our parent, is, combine everybody, we're not even close to that. But the idea is that Flagship, we want to focus on being the lender and really being an expert in the lending business, where we want Carfinance.com to really focus on bringing technology around that we will be meeting that customer need. As more and more millennials enter the auto market, that's really the thought, is that we will represent to them we will be a tech company that happens to be able to provide them banking services, or at least specifically to auto finance, services. And that's kind of part of our mission within the car finance side of the Flagship business, is to really be somebody that our customer sees not as some bank which they don't want to do business with, but where the 72% want to do business, which is with a technology company, really meaning with somebody who's innovative and on the forefront and really using technology to its best to make it easy for the consumer what they want to do.
Right, okay. And let me ask you just a couple more.
Sure.
You had mentioned about how you want to avoid going down a road where the dealers are going to have to invest in a lot of hardware. That was my takeaway.
Yes.
Can you put any money on? Can you put any figures on what kind of money would it require for dealers to if one were to go down that path?
Well, yes. I mean, what I can speak to is some figures from some years back. I don't really know the pricing today on some of the electronic contracting subscriptions and hardware that is being offered by a dealer track or a Route 1. As you mentioned in introducing me at the beginning of this, I did work at dealer track for about 6 years. That was 2003 to 2009. Familiar with, at the time, the e-contracting prices for subscription was generally a few $100s per month for a dealer to subscribe, and then they purchase pads as electronic signature pads as a one-time expense, a hardware expense, and those were usually a couple of $100s as well. I don't know what has happened to either sets of those prices, and I don't know what specials dealers have, or if prices have gone up or down, or however e-contracting is working with dealer track, let alone for Route 1. But what I do know is that, assuming there's still some cost involved, the dealer has to compare that to, if they're not using those products, then what they're doing is printing contracts off, generally printing them out of their DMS, presenting it to the customer, getting all the necessary signatures, and then packaging everything up into an overnight envelope in order to get the packaged through their lender as quickly as possible to get funded as quickly as possible. Putting all that together, the signature itself is free. I mean, it's like, okay, there was some paper and ink involved in the printout, but you didn't have to do anything as far as paying any technology provider for that. And I did mention, and this is really more of this is not really even on our product roadmap for Flagship as a whole for 2016, but it's more of a trend that we're going to look at is there's no reason to think that a contract can't be presented by a dealer to a consumer on that consumer's phone. Now, obviously, DocuSign is also not a free product. I mean, we have a partnership with them. They've been a great partner of ours, but, that is also it's a vendor relationship from the standpoint of we pay them for the services they provide. It would be interesting to see who will absorb the cost. It will be split between dealer and lender, or who will pick that up as far as the costs of if we move to an electronic contract. Both the dealer and lender will benefit from that in an indirect world, in addition to, obviously, the consumers. It will just be something new for the consumer, a different way, as opposed to being handed a pen and being told, sign here, here, and here on paper documents to, tap their finger to 3 different points on the phone, or however it will work as far as that goes. It will be a little different for them, hopefully better. Hopefully they'll see it as being more secure. But the real benefits will be to the dealer and the lender, and it will be interesting to see where that cost breakdown goes as far as who pays for what. But I definitely do see that one thing it will take away is the cost of those pads, because the consumer will have brought their device. They will have brought their phone or their tablet with them. And with that, those pads, again, adding up to a few $100s and lasting, hopefully lasting several years. But, even if that's the cost of it, $100 per year per pad, if you average it out, if that goes away, that would be something that would be, that would be a definite benefit to the dealership.
Right, and plus if you're envisioning having one at every workstation, and maybe even a couple of sort of non-traditional workstations as well.
Exactly.
So thanks. I'm going to have to cut you off there. That's all we're going to have time for today. And let me wrap up with the Center for Auto Finance Excellence is committed to bringing you quality content on best practices in auto lending and leasing. We hope you'll join the center at www.autofinanceexcellence.org to receive our alerts and to participate in other center events. I want to thank John one more time for his presentation, and please be sure to keep an eye open for additional events from the Center for Auto Finance Excellence. Thanks once again to our partner Fiserv as well for their support. This concludes today's teleconference. Have a wonderful day. Thank you very much.